And we wouldn't be here tonight if it wasn't for Shepard Mullen, and Bill Wyatt's just going to have a few words. Bill's one of the lawyers here.
Hi, and welcome everyone, and thank you for coming. Shepard Mullen is happy to host these events, and always very interesting topics. Shepard Mullen is a national firm, actually international firm. We have about 800 lawyers and about 16 offices, most in the US, but 3 in Asia and 2 in Europe as well. And I'm a finance partner in the Silicon Valley office down in Palo Alto, where we are often a little more cramped than we are here. So I'm particularly interested in the subject tonight and what the panelists have to say about credit.
Thanks so much, Bill. And so now I'm going to pass it over to Mark Krager from Next Stage Partners. He's the moderator for tonight, and he'll introduce the panelists. Thank you.
Thank you, Pimo. And just a quick comment on cryptocurrency. I had a chance to go to the MIT Northern California chapter meeting last night on cryptocurrency. And one of the questions of the panelists was, how much will Bitcoin be worth by the end of 2018? And the estimates ranged from $1 to 100,000. So take that in your investment portfolio and do what you will. I did, as a joke today, called an advisor I have at Wells Fargo to try to buy some cryptocurrency. And I think I was talking with somebody in Iowa, and they were discouraging, and they could not help me. But I said, someday big banks will get into that. Don't you worry. But thanks for joining. We've got a tremendous panel. We've got an interesting list of questions that we've talked about together, and we're looking forward to any kind of interaction from the audience. I think we typically have a Q&A session at the end, but given the size of the crowd, if there's a comment that you want to chime in on, raise your hand. We'll try to keep it as interactive as we can and still stay on track. I am a principal and founder for Next Stage Partners. I'll talk a little bit about our company at the end. Coincidentally, I have the opportunity to give a pitch on our company at the end of the session, so it's certainly worth sticking around for. But we are a sales, marketing, and business development team working with early stage companies. I'm going to pass this down the line and just have everyone do introductions on themselves.
Hi, good evening, everyone. I'm Rohit Bodas. I'm a partner at Propel Ventures. We are an early stage FinTech focused fund headquartered here in San Francisco. We like to invest at the Series A and B stage. Most of our investments to date have been in the US, but we just closed a new vehicle and we're actively looking for investments across the world. A few investments in our portfolio, Coinbase, Prosper, as well as portfolio companies, DocuSign. We have a fairly broad definition of FinTech, not just investing in verticals like lending, insurtech, wealth management, etc., but also more horizontal capabilities around security, RegTech, marketing automation.
I'm Sumit Pajmani. I'm the general counsel at Nova Credit, a fintech startup based in San Francisco. And we're focused on solving a problem that many immigrants face, which is not having a credit history here. And the way that we sort of solve that problem is by acting as a cross-border credit bureau and facilitating access to international credit data so that folks can make more informed decisions about that.
There are 78 million hourly wage workers in the United States that have 100% income volatility, and their employers have an attrition rate of 70%. My name is Akshay. I'm the founder of Teller, and we are solving this problem by building a mobile-first solution that lets employers provide daily cash incentives to these employees, thereby reducing attrition and contributing to their financial stability.
Brad, if you could maybe share that microphone down there, we'll keep one on here so we're going back and forth.
Sure.
Without throwing it.
No, absolutely. Thanks, Mark. Brad Pennington. I'm the Chief Risk Officer at Prosper Marketplace. Prosper is the first U.S. peer-to-peer lending company, and I've actually been with Prosper for about 5 years, where I built out our data analytics and machine learning practice.
Hi, Jonathan Gole. I work at Capital One, particularly in our credit card business. I lead a product management and business analytics group focused on modernizing and reinventing a lot of our underwriting and data infrastructure, really focused on real-time analytics, enhancing our underwriting practices through improved machine learning and improved data sources.
Hi everyone, Victoria Cheng, Senior Vice President, Citi Ventures. So we are the innovation arm for Citi, and the way that we think about investing is really across two different areas. One is enterprise IT, technologies we can leverage ourselves to build better solutions. So think about that as data, infrastructure, security, marketing tech developer tools. And then on the other side is products and services that touch our clients. So obviously all of FinTech, lending, banking, payments, wealth management, insurtech, trade and treasury services, capital markets. We service both consumer and institutional. And then of course commerce, right? Which is one of the reasons why you have payments. So we're usually investing across the spectrum. So we can do anything from a Series A to a Series Z. Our sweet spot is companies that are post-product development and in market, generally somewhere between the Series A and a Series C.
Great, thanks. We have a list of questions that we've talked about, and I think if we were going to have this session at the beginning of 2009, the questions and the answers would probably be a little bit different. And I think there's a lot of things that have gone on in the credit space, how banks are responding to credit needs, how alternative lenders have come into play. So I've got a series of questions. I'm just going to pick on somebody on the panel to answer one, but feel free for other people to, when I say pick on, I mean that affectionately. But Jonathan, I'll start with you. Can you talk a little bit about how the traditional credit scoring and underwriting practices are changing for established markets?
Yeah, sure. So I think one, it's being enhanced by improved access to additional data sources that we can use to enhance our underwriting practices. So I know actually another person on this panel that's the role of their company actually is to provide better data, international data that we could use to perhaps underwrite customers that we had very little data on previously. Additionally, machine learning just allows us to understand much more about customers through those kind of broader data sets. I think those are two of the big kind of really practical trends driving underwriting improvements at Capital One. Although I'm sure there's a lot more to come, just given the pace of technology advancement currently.
Great. Sumit, I was kind of going off of that. We're talking about some of the things that are happening in emerging markets for credit. And can you talk about how some of that is changing and influencing the practices of extending credit in the U.S.?
Yeah, to sort of speak a little bit on that, I think I sort of view two things that are sort of happening. I think one is finding new techniques and new ways to look at existing data sources. So, in the U.S., I think folks are, if you look at the sort of FICO model, it's sort of modified outlooks at paid collections or medical collections, things like that. Trying to adjust that for various reasons, but including sort of providing sort of additional lift there. But I think the other sort of key focus is thinking about alternative data sources and alternative populations that you can reach with that. So I think some of the big trends that you're sort of seeing are sort of how do you reach people that either were underserved by traditional financial markets or are less comfortable sort of with the traditional financial markets. So, with Nova, I think we're oriented towards helping a problem that it's an underserved population of sort of immigrants or folks who have moved from country to country where their financial identity hasn't followed them. But you can see sort of similar trends where people are thinking about, if somebody doesn't have a credit card or if a millennial is skeptical of using traditional financial products, what are products you can design to help that population, or what are ways you can think about reaching that population?
Great. Any comments?
The other trend is there are people who are under the radar. That means there is no data on them at all, right? So how do you start creating data for these individuals? And what kind of data would you create? And then how would you score them? Applying traditional models and traditional programs to do for these individuals would not work. For example, what we are trying to do is we are first trying to understand, what is the nature of, what is the financial life of these individuals? What is their employability? We're giving scores on employability. We're giving scores on their income, their expenses, their fixed recurring expenses, their fixed variable expenses. And we are collecting data and creating it from scratch because we cannot rely on traditional sources. So that's a big trend, especially with 59% of the workforce being in that space. I think that will be a bigger trend in the coming years.
So do you see your company in terms of the products that you're making available to, let's say, QSR workers or retail or manufacturing? It's a prepaid product. And do you see that as an opportunity to, once you have, go from a no file or thin file, what is it that you think would be necessary and what learnings can you share with organizations or yourself to give them access to better products?
I think they are at a point where they are even incapable of consuming credit if it was given to them. So how do we provide tools to get them to a point where they can do that, and then usher in an era where they understand how to use it, better use it, and what are the advantages of it, and then finally get to a point of wealth management. So it's going to be several years, and we are at the very cusp of it. It'll take time. As far as prepaid, I feel the prepaid market is a little challenging, especially for these individuals. They're making less than $30,000 a year, right? Prepaid cards mostly have fees for everything. You swipe, there is a fee. You withdraw money, there is a fee. What we see, at least, or what we intend to do, and we think other fintech startups will also do, is trying to become bank. Like our eyes, for example, are very clearly set like a hawk on the comptroller saying, okay, I'm going to give out this new banking license. So we got to be after it, so that we can provide all of these services, what traditional services would have been there, at a much, much lower cost to this new generation of users. Great.
John, do you have any comments relative to Cap One and kind of approaching the thin file, no file?
We've that's a segment that we played really strongly in for quite a long time. Mm-hmm. I do actually happen to believe that it's companies like Akshay's that are probably likely to create the most disruption in financial services, like the origin of Capital One. If you kind of attack the market from the bottom up, there's just a lot of opportunity for disruption and scale versus an awful lot of competition at the kind of super prime kind of lending. So I think certainly what he talked about in terms of getting additional data sources on customers, finding ways to both help customers understand how to use credit wisely and prevent themselves from getting in trouble is really big step to helping them build their financial future.
Yeah. And I just say from personal experience, prior to Next Stage, I was with Visa for quite some time and did a lot of work to launch prepaid products. And I was at a major issuer here in San Francisco, and big round table of SVPs and EVPs, and I was talking to them about the line of people they had in their branches every Friday waiting to cash their checks. And the bank did not have any interest in having those people as customers. And it was irritating that the regular customers would come to the bank on Friday and see this big line of people. I said, how about if you gave them a product that had your name on it, could access your ATMs, could give people a tool to manage electronic deposits so they wouldn't have to worry about cashing a check. It would automatically be available. And there's one guy sitting at the table and he's like, hold on a second. If you're talking about reducing the number of checks we have, I'm compensated on how many checks we cash. I've got a problem with that. And I'm like, I need to talk to your boss. But it's a good example of saying, if you issue a card to somebody and you get repeat behavior, and maybe that repeat behavior is a deposit once a week or twice a month that shows a steady job, as an issuer, you can take that product and you can take and use that to make extensions and say, I didn't know anything about this person before, and now know that they've had the same job for 12 months because I see the direct deposits. And it's just a good way to do that. And kind of along the lines, I'll just throw this open to the group. Some of the other ways to do kind of verify credit, people have been using social network. Whether it's Facebook or LinkedIn to kind of verify personalities. Anybody want to just comment on use of that type of technology or data source?
I can say it's not something we use much currently for underwriting at Capital One. I think largely due to reputational concerns, wanting to protect the privacy rights of our customers. I think it's certainly an interesting space, but one which to approach morally, we'd have to be really careful about.
Mm-hmm.
Yeah, I think we're definitely, similar to Capital, I guess, actually much more interested in alternative data sources that are verifiable, but not necessarily under the general net of what's going on to underwrite. So, LinkedIn and Facebook, aside from some of the reputational concerns, I think one major problem is you're allowed to create your own account, and that clearly has pretty negative fraud ramifications.
Right. Brad, can you talk a little bit about some of the threats that traditional lending institutions might have from alternative lenders?
Yeah, absolutely. I think that if you go back, so I've been with Prosper for almost going on 6 years, and so initially when we were kind of in the market, it was an advantage that we had a product that was online and it was a native digital product, and it wasn't a phone number that was pointing people back to a person in a branch. That was a real source of advantage. I think banks, by and large, have really caught up, and even some of the super regionals now have done a pretty good job cleaning up their digital interface. I think that it's always this constant threat of how can you it's interesting to see that Jonathan is kind of the head of product at Capital One, and so I think some of the companies in the traditional space that have had the most success have adopted a lot of the agile processes that the technology companies use, and for a while that's been a really great source of success and advantage for Prosper. It's really changing that culture to one of continuous innovation, and I think that's companies that don't adapt to that mindset will find themselves having a lot of trouble. But there's a lot to love about being at scale as well.
Mm-hmm. Great. One other question kind of leading to technology, and maybe it's not social media, but Rohit, kind of what are you seeing in promising technology developments that will enable more aggressive, I say aggressive in a positive way, but competent lending?
Is that for?
No, for Rohit.
You can answer.
Yeah, you can both answer.
In overall, I would say lending as an early stage asset class is slightly out of favor, especially in the developed world. Emerging economies, there still are opportunities for lending. In terms of the challenges right now, you alluded to it, large companies have significant advantages on cost of capital. I think that's a problem that is very difficult to address right away. So I think that barrier will still remain in the foreseeable future. From a technology perspective, there still are challenges in terms of aggregating data from multiple sources for data privacy concerns. There have been some advances when it comes to sort of differential privacy, which allows combining insights from different data sets without really transferring data, which could potentially help companies in improving their risk assessment. So I'd say better data and data accuracy. In a number of startups that we've seen, there are still major challenges when it comes to accuracy of data that they're aggregating. And all these things just raise the cost component from an underwriting perspective, user acquisition perspective. I think when we talk about lending companies, we focus too much on alternative data sets for risk assessment. That is super important, but we like to think of it as the whole journey. What is the cost of customer acquisition? What is the cost of collections? All these, the cost associated with all these elements have to be factored in. And so I don't see anything super disruptive in the near term which addresses all these solutions, but there are technological advances which address these individually.
Great. Victoria, any comments? There's promising technology developments
Yeah.
that you think will lead to more aggressive lending.
So I don't know if I would use aggressive, because when I think of aggressive, I think of taking on greater risk, right? And I think actually the really interesting innovation is around decreasing risk and having better risk assessment, right? So what I'm always still interested in is companies that have figured out how to find what is currently mispriced, right? And a lot of people talk about using alternative data. It's not just about alternative data, but it's about, do you have proprietary data and the timeliness of that data, right? So what's been really interesting, I think, these days is the information that you have when you actually get it gives you insight to a customer or a small business, right? So, we're investors in Square and in Bluevine and in FastPay and a number of these companies where they know exactly, okay, how much have you made because you've linked your bank account, right? So we can actually look at where are you today instead of just have you paid in the past once a month on your credit cards, right? They can look at things like your accounting information, right? So are you actually making the sales that you want to make? So I think all of that plays into being a better lender, not just a more aggressive lender, if that makes sense.
Absolutely.
One more area I'd like to talk about, haven't seen anything yet, but if someone has a solution, would be super interested. Obviously, AI, machine learning is just going to continue to increase. That's not an issue. The challenge is from a transparency perspective. Someone can figure out how to address bias or provide tools to allow data scientists to remove bias in training data. That should just increase the adoption of AI and data sets in underwriting. So I think that's a problem that needs to be solved.
That might be part of our bonus question. Technology that doesn't exist yet. No, it's all good. I've got a few scenarios, and one of them is, first one is small business owner, and I'll just throw it open to first whomever would like to respond. But if I'm the small business and I need credit to grow, but I don't necessarily have the business yet to justify the credit that I need, I'm in that catch-22 situation. Are there tools that I could use as a small business to better project my worthiness than what we traditionally have used in the past? Is that too granular to say small business?
I
think we're consumer only platform.
Yeah.
I can share a little bit of light. I feel other than the traditional PayPal products, I think PayPal Working Capital is a great product. And they are able to provide, they are the acquirer in this case. And they are the issuer for the customers who are using PayPal, and they can correlate a combination of this data and see predict cash flow. And yes, they do ask for some amount of data, but the amount of data that they're looking at is tiny compared to any traditional lender or even some alternative lenders. So they're lending right on their acquiring business, right? So they'll say, okay, fine, we think that your cash flow is good for $30,000, and every time somebody spends money, and when we charge you the $3.30, we'll charge you the additional fee as well, and it comes out of it. So they're sucking right into the cash flow, but also putting money back into their business. And as the business grows, their PayPal's business also grows. So I think that's an interesting area, and I think their machine learning, their algorithms will start getting better and better because they've been at it for a long time now.
Mm-hmm.
Yeah.
I can actually. So we have a portfolio company called Bluevine, and what you're talking about oftentimes is there's a small business that today, maybe historically they haven't had that cash flow, right? But they're growing so quickly. Maybe they have a number of big clients, right? Maybe Costco or Walmart are buying from them. And so they're trying to get this money in order to fulfill that growth and fulfill those orders. And so in that case, you can actually turn to something like Bluevine, which is around invoice factoring, right? So you have the invoices, you know that they're coming, and so you can actually use that as collateral, which is different, right? So it's this growth capital that's available to you because of the promise of your future growth.
Okay.
Yeah, I think broadly that trend exists across lending, not just for small businesses, but the lenders who can get access to up-to-date, detailed financial information about their customers more quickly, and then have the agility to respond to that very quickly, and thus stay really up to date with the financial profile of their customer, whether it's an individual or a small business. That just gives them the opportunity to help that customer achieve their goals more quickly, and have smarter risk management.
Great.
I mean, lenders have their criteria that's established, right? I mean, blue wine has a certain set of criteria. Same thing with cabbage. Everyone. The challenge is sometimes I don't know what a small business can do to enhance what they currently are. There's no you can do fraud, obviously, but there are marketplaces which allow a small business to get connected or to figure out who is a better match. Is invoice financing a better fit for them? Is working capital loans? It depends on the need of the small business, and there are many options, and it comes down to maybe education or lack of education. So marketplaces are emerging, and there are a number of them. I wouldn't want to name any, but there are several options out there.
Great. I'll take that back.
Go ahead.
From a VC perspective, and Rory might give you this microphone back, but what are some of the safer or riskier bets that you would want to evaluate when looking to augment your portfolio relative to credit lending?
So I'm not looking at lending opportunities in the US for the most part, because I focus mostly on international opportunities. And I think that from an international perspective, there still are many areas that are underserved. From a geo perspective, I think Asia minus China there's still opportunity out there, and I would say the products don't differ too much in Asia or emerging markets. It's just completely due to lack of data, lack of access to credit. Latin America is fairly interesting right now. I'm more interested in sort of business financing solutions in emerging markets, trying to replicate business models that have worked in the US. There still seems to be ample opportunity. So I wouldn't say one is more riskier than the other, especially in emerging markets. The challenges are still the same. It comes down to how big can the market grow and cost of capital. I'm focusing more on companies that can have the ability to attract capital, and most likely it is always international capital because there isn't a lot of domestic capital in those emerging markets. So yeah, those are some of the areas I'm interested in right now.
Okay. Victoria?
Yeah, I think that, what I've been interested in recently is less about, hey, I'm another great marketplace platform, but how do you actually distribute that product, right? So one of the biggest costs for any lender is cost of acquisition, right? So have you figured out some interesting channel in which you can actually get closer to the customer when they're actually making those decisions, right? So nobody sits on their couch and says, hey, you know what I want to do today? I want to go and apply for a loan. But let's say you're in the process of purchasing a large trip, right? And in fact, it turns out, oh, you can actually pay for this over time. Or you want to, we just bought a new mattress, right? And so now you're going to spend a couple $1,000s. Well, maybe you don't have to all at the same time, right? So I think companies that are thinking about that in a different way, where you're working with a channel, it's beneficial to both you and the merchant partner. The merchant gets, a larger basket size, maybe a faster conversion, and you get the opportunity to leverage that channel and their customers and provide something that customers really want, right? I think for a long time, we've talked about payments getting into the background, right? The goal of a purchase isn't to figure out what's the coolest way I can pay, but I want to buy this chair, and how do I get that chair in my hands? And I think it's the same when it comes to lending. It's another form of finance to receive a particular product, right? So I think those types of companies like Uplift or Affirm, or there's a number of others that are thinking about how do you tackle that, Klarna. That's interesting.
Great. If I'm a FinTech startup, let's say, outside of what you might consider investing in, are there areas that maybe some of you are looking at right now, or that you feel are unsolved or partially solved, where a company could be successful in particular product development? Is there a product out there or that you have or you're developing that if you're a FinTech startup says, this is what's going to make the pain points for all parties, the lender, the borrower, more successful? I'll throw it to anybody. Sumit? Sure.
Both because I don't want people to do what we're doing, but also just because I like to think about things that are sort of outside my realm. One thing, just sort of having looked at various sort of aspects of consumer credit, that I've always felt that there needs to be some type of solution, and I won't have a specific answer, is really the parts of the credit cycle that nobody wants to touch, like collections or like an overdraft solution or like something where you're helping people at a time when they have like an acute need, as that is just not really being sufficiently addressed, and is a population where I think like if you can help them in the right way, it's going to be a very sticky population. And I kind of think of that in sort of the same way that we think about our business. If you're going to help an immigrant get sort of their first like true great financial product, they're going to stick with whoever provided that product for a long time. So if you're going to help someone who's suffering from like running out of funds in their bank account on like a one-time basis and find a solution where you can address that need, and I haven't seen anything that's really great at doing that so far, like that's going to be a population that's going to sort of stick with you and grow with you, and similar to sort of the market that you're trying to address, sort of like thinking about those types of products and that population that can grow with you and really stick with you that way. So for me, it's collections and overdrafts is sort of like the two like things that really need a technological solution to make it more efficient and make it easier on all parties involved.
I think using technology to kind of educate these individuals and helping them, like get to a point where they can understand, access, and use credit. I think that a creative way to do that, and to do it with the ecosystem versus doing it in a silo, like just addressing it from consumer's perspective or addressing it from a business's perspective would not be conducive. It has to be done at the ecosystem level. So how do you get the whole ecosystem and its players to play well with each other, and thereby uplifting the whole ecosystem? I think that will be killer. Shameless plug. That's what we are attempting to do. I feel that's where true money is. I also feel that if you're starting a fintech solution or with the mindset that okay, I want to do a fintech startup, in my opinion, you're going to fail. I think what Mark Anderson said, that software is eating the world, that's going to come true to the financial services space as well. That software is going to eat the financial services space as well. And the way it's going to eat is it's the technology companies who are not they're not thinking like a financial service organization. They're not trying to build a lending business. They're trying to solve a problem for the customer. And as a side effect of that, they're getting into financial services. That was not their first intention. And that will be the big differentiator between incumbents and new startups. And those incumbents who start thinking that way will survive. Those who don't will get eaten over.
Okay.
So not really a credit product, but and I wrote a blog about this back in, I think it was maybe January, February, earlier this year, which is, is it possible for us to actually be much more proactive with our customers, right? With all customers, and not just around credit, but around financial services overall, right? People don't really have this need for, I want to go get credit. It's more like there are certain goals in my life I'm trying to achieve, certain things I'm trying to purchase, certain ways in which I want to retire on the wealth management side, certain ways I want to provide for my beneficiaries, right? And so how do you actually give the right products at the right time for the right customers? Right? So I think there's this tremendous opportunity leveraging machine learning, potentially, artificial intelligence, if we get there, that is around giving these personalized advice and products and capabilities to people. And then one step further, ultimately in a way that is personalized. So how I like to receive that kind of advice may be very different to how anyone else on this panel wants to receive that kind of advice, right? So I think there's a tremendous opportunity to leverage new capabilities, new technology today that we haven't seen before.
Yeah, I'll add one more area, which receives a lot of investment today, but still has a lot of kind of systematic and ecosystem challenges, which is that of fraud, particularly identity fraud. So I think any improvements that financial institutions make in detecting and preventing fraud is a very clear win-win both for us and our customers. We prevent our customers from getting in trouble and dealing with an awful lot of stress and challenges that come from their identity being stolen and financial accounts being opened in their name. Clearly, we then lose less money to fraudsters and can reinvest that money in improved customer experiences or lower rates for our customers. So there's a lot of technology investment here, but I think this is a domain where there's also ecosystem challenges. The better information sharing that could exist between financial institutions, individual customers, public and governmental organizations could create a really big paradigm shift and would have to involve improved technology as well to make it real.
Yeah, maybe last one, either another one, I guess, if nothing else. It's been exciting to hear, I think, a lot of being in financial services. I think a lot of folks forget about the sort of the second half of that, which is the in-service kind of part of it. And so, that's something that we really try to focus on at Prosper as well. So, Will, actually, Jack is in the room here. So what I've been really excited to see is, we income verify something like 80% of the folks because we give pretty high dollar value loans. Mm-hmm. And just the explosion in the ecosystem with some of the marketplace lenders coming to scale, being able to have specialty services that are serving a specific kind of vertical need. So, income verification and employer identification, I think you wouldn't have seen as many advances in that space because, if you had to get, maybe not a Cap 1, but if you had to get behind the general bank sales cycle in order to recognize revenue for a specialty service, that used to be a really challenging thing to do, and you'd have to raise a lot of capital in order to do it. So I've been excited to see more and more over the last couple of years, folks entering some of those specialty niches in the ecosystem where maybe, even 3 or 4 years ago, you wouldn't have been able to have a viable company. But, today you can have a viable cash flow positive company and, maybe 2-3 years in the future, you're entering the bank sales cycle.
Okay. I wanted to kind of enter into a little bit more of a speculative round with everybody participating. And I think the first question is, if we take a look at the credit business right now, and again, this isn't 09 or 10, it's 2017, almost 2018. What do you guys think is the biggest risk today in the credit business? Something we're going out too far on a ledge, we're not addressing a problem that exists out there. I'll just kind of open it up for each one to give a response.
I mean, recession, I don't know, maybe that's too simplistic of an answer, but a lot of people lose their jobs, they lose their ability to pay. It's a pretty fundamental problem.
My answer may be similar. We've had something like 9 years of economic growth at some point that will end at the kind of, there's a chance that we're kind of at the top of the cycle, the kind of frothiest portion where we actually may have greater lending risk. So any economic downturn, that would be an obvious thing. I still think, not that we are in the same situation as 08, but large-scale systematic risk is still the largest problem that any financial institution faces, and there are still big challenges out there, particularly with student debt that may challenge lenders. Given the emergence of FinTech companies, some of which or many kind of that are concentrated in similar customer segments do not always report to the credit bureaus. The amount of kind of hidden debt that's kind of off of credit bureaus or that financial institutions are not fully aware of may also be a challenge going forward.
That's great. That's a few answers there. They're all good ones. Victoria?
Yeah. So I think a couple of things. I mean, certainly, at any point in time, you want to make sure the economy is growing in such a way that the people who are taking out credit have the ability to pay, right? So you're always looking for economic growth in employment. I think the dangers, of course, are always around recessions. There's always systemic issues. I think what's been interesting, especially since we're all in the FinTech world, is that the access to multiple different lenders is much more, it's more easily accessible than it's ever been before, right? And yet that data that in fact this person maybe just 30 minutes ago has applied for a different loan and now is coming to apply for a loan with me, is not necessarily easy to access, right? And so then the question of, do you end up with people getting multiple stacked loans, and does that increase their risk? That's something I don't think that the industry as a whole had expected at the time in which we had begun to grow, right, overall. But it is exciting. It's a chance for us to address that.
Go ahead, Samir.
And I would sort of add, in addition to sort of agreeing with what was already mentioned, as a data provider or facilitating access to data, I think one thing that can't be ignored as we shift to financial products being entirely digitalized in a lot of different ways is the obvious sort of security concern of like if data is going to be moved around in all these different places, if it's going to be the basis for facilitating a lot of these transactions, security is a top of mind concern and sort of thinking about how that works and thinking about how companies like us, how we build our systems to make sure we address that. Companies that started before, how they update their systems to address that. I think that's going to be one of the big ongoing challenges that just faces the industry. As I don't know how many people in this room would actually have actual paper bills that they're dealing with versus all of their financial identity and data online.
As a startup, there are two, for lack of a better word, nightmares that I see. Number one is by 2020, 40% of the population is going to be 1099 workers. That means tremendous amount of income volatility. And traditional as well as alternative lenders have not created a model to lend to these individuals, right? And that might coincide with a recession. That means they don't have money, and the lenders have the well has dried up for saying, and at that point it becomes a big challenge and becomes an economical. It's going to hurt everyone. It's not just going to hurt the 1099 workers, and so that's one nightmare. The other nightmare is we see a lot. Financial services have to be capitalized. It's a capital-intensive business, and you need more capital. That's a given. But I do see these direct-to-consumer payday loans that are coming up that are very highly capitalized, but the model that they're using is not so great. I see that business getting hurt if at all we reach a recession, and that in fact having a ripple effect on all other startups that are trying to address that market. Right, and investment drying for that space. I think more investment is needed in that space because there's a huge labor shift that is happening, and these are the challenges that I, on a day-to-day basis, think about.
Great. Okay, short of us having any patent attorneys in the audience, despite the fact that we have a video camera on us right now, I just wanted to have a little bit of fun and say if there's a product or service or idea that could really move the business forward that hasn't been invented yet. Do you guys have any idea what that would be? Pass it on. Feel free to answer.
I think I already alluded to it. I'm super interested in figuring out how to get more AI used that will be transparent enough for credit regulators to agree with how it's being used. So something which gets transparency. You can figure out what is the exact reason why a loan or applicant has been rejected while still using the advanced levels of machine learning would be super interesting.
I'm just going to use this as a shameless plug and say cross-border credit reporting. Look out for it.
Same here. Building credit history from scratch, understanding that space and helping build that space up. I think that's going to be killer technology, so watch out for Teller. In addition to that, I personally feel that new lending models, specifically keeping income volatility in mind, is going to be huge. And finally, machine learning on small data. It's easy to do it on big data, like looking at a lot of data and then creating cohorts and then comparing them is easy. But if you have to do it at an individual's level, it is challenging. We ourselves try to do it on a daily basis, and it kills us. So anybody who can crack that and do it really well, I think it's going to be killer. So
what pops out at you that creates a problem when you're looking at such a small sample size that you can't see or determine on a larger one?
You cannot use. There's a lot of research being done in how do you do machine learning with data. You cannot use traditional models. You have to come up with new ones, or you'll have to use a combination of them in different planes. I don't want to go into details because that's our IP, but
it's just us. Don't worry.
Yeah, it has been challenging. So it took us. Just to share an interesting story, we were pushed to a point where we said we need to have an intimate understanding of a person living with income volatility, and we cannot get that because people are not going to be that open, that we had to take a leaf out of Daniel Day-Lewis's book, and I'm actually living the life of a person with income volatility. So for the last 6 months, we have been fine-tuning our algorithm, and I've been living without paycheck on Airbnb income only, and we've been testing our algorithm against it. And that has helped us get to we use all of the products. We use Even, we use Active Hours, we use Dave, and when we run our algorithms against those, we're getting better day by day. But still, we are far, far away from what could really be good. Yeah.
Brett?
So Rohit, you and I should talk because we actually implemented something like what you're talking about for the machine learning algorithms we use for credit decisioning. But
on an individual level.
Yeah.
Yeah, of course.
And then I guess second, what I'd really look for is I think OCR had gotten a bit of play for a while, so optical character recognition, but the application of that data to the actual types of documents that people send you, there's a real disconnect, and I would love to see a service provider actually step into that and use applied OCR for the dirtier kind of lower resolution images that that actually come to you, because at the end of the day, if a person can read it, and we have many people that do read them, it would be even better to have a machine do that.
John?
Yeah, all great ideas mentioned so far. We talked a lot about, I think, just given the nature of the focus of credit in this panel, we talked a lot about underwriting in acquiring new customers. So I'm going to put a different lens on it, particularly because I work in the credit card business. We manage really long-term lending relationships. There's just so much leverage still in helping customers at an individual, personalized level in their long-term financial journey and adapting that journey for them over time, particularly with an emphasis on helping people save money and find financial practices that will be healthy for them over time and create a kind of virtuous cycle for their financial health.
Victoria?
Yeah. So first, since we've talked about machine learning a lot, along those lines of machine learning and transparency, I would plug Data Robot, take a look at that product. I think So first of all, most of my time is spent investing in founders far smarter than I, so I expect that they'll have way better ideas than what I'll be throwing out there. But one thing that I'd love to see is something a little bit more comprehensive in the sense of, how do I change the behaviors of individuals through the types of products that I have so that they can have, over time, access to better solutions, right? So, before I was talking more along the lines of, hey, it'd be great to have a financial advisor that can advise you towards a goal across everything, right? Whether that's wealth management or lending or whatever products you should have. But the other side of that is, how do you change the behavior of the customer, right? So that they know, hey, actually, if I pay off these utility bills, or if I can reach this next revenue number as an SMB, then all of a sudden now I have an access to a different product I didn't know was possible, right? So building that kind of transparency for the customer, I think, can be really interesting in the long run, because now you're influencing not just, hey, here are the products we have for who you are today, but based on what you do, we can give you a whole new suite of products, right? And so giving them the access to what are those steps, what are those characteristics, I think can be really powerful.
Great. I think that's some great ideas. We're going to open to questions for the audience here, but before I do that, is there any, without shameless plugs aside, is there any other questions or topics you guys wanted to discuss? Questions you had that you wanted to ask the rest of the panel? What did you cover? Okay. Let's turn it over to our vast audience. Yes?
Yeah, you all seem very comfortable with the concept of credit and finance and everything. But I would like maybe one or two of you to comment on the fact that a lot of people just don't trust it. The banks, the financial institutions, just offering credit. I will see the mail in my mailbox, offering me a credit card. I don't trust it. There's a whole lot of people who are like that. Can someone comment on that?
Can I ask just maybe a qualifying or clarifying question? Are you talking about that you've seen that degrade over time, or it's been a problem all along and you just don't feel it's being addressed?
Oh, especially after 2008, 2009.
Yeah, okay.
A lot of people went through foreclosures and all that stuff. There's a way the financial institutions dealt with people at a time that people didn't make the proper bad cases.
Sure.
Yeah,
John, you want to comment?
Sure, yeah. Certainly understand that a lot of people have lost trust in financial institutions. It's also a trend, I think, that is quite prominent in millennials who are just less likely to look for credit earlier in their career. I think it's on us as financial institutions to prove to customers that they should be able to trust us. I think you said earlier really well that protecting customer data is a really big part of that. I think protecting customers' financial health, looking out for them. It's pretty easy for people to get into trouble using credit and financial instruments. We shouldn't be taking advantage of that. Instead, we should be trying to look out for what's best for our customers, because I think in the long run, that's actually what's best for us as well, both because of maintaining long-term relationships with those individuals, and also because of the enhanced trust it will create for our institutions.
Brad, any comments?
Yeah, I think over the long term, money follows value. So as long as your focus is on creating value, and as long as you actually are creating value for your customers, I think that's the thing that ends up building trust.
Great. Yep.
If I may ask a question about, so I wanted to ask a specific question about what you just said, Jonathan. And one of the challenges with credit cards is the question is, how do you look out for your customers' best interests when most of the money is made on credit card products from interest and fees?
Well, that's not entirely true in that we make a really large percentage of revenue off of interchange. So a customer who spends a lot of money and pays it off every month and is very low risk and high revenue is actually an excellent customer for us. Now that is to say, we do make money off of off of finance charges and interest. I think what we try to do is put really intelligent barriers in place. meaning we need to, well, first there are regulations mandating that we kind of look out for the customer's ability to pay, but we go beyond that and trying to predict customers' ability to pay and try to put limits in place that prevent them from getting themselves in trouble. As I mentioned earlier, what we want to do is kind of create a virtuous cycle where people can establish credit, pay it off, and to a point, like get access to better and better financial services that help improve their finances over time. So I agree that it can be difficult, but we're trying to do that and help customers kind of build that bridge to better wealth and success.
I think you're starting to see a shift towards financial advocacy and financial advisory around credit, right? And you'll see it in the FinTech community. Companies like Clarity Money or companies like Dave that are about, hey, not just like here you can get credit, but here's what that impact of credit will be on your long-term cash flows, right? And so you can start to be a little bit more educated around what is the cost of taking out this loan if I do it, if I, should I be purchasing what it is that I want to be purchasing? So I do think you'll start seeing even more of that.
Yeah, so a number of you have talked about alternative data sources and different ways to get information. Is anybody data mining or looking at bankruptcy data, and in particular consumer bankruptcy data, Chapter 13 filings and the payment plans and so on, and looking at that data as both from the point of view of trying to figure out what goes wrong and therefore how to avoid what goes wrong and giving you some better insight into how things go wrong, as well as Chapter 13s involve payment programs over 2 to 3 year periods, what that looks like and what that might tell you about the way that some underserved consumer groups use credit and what their cash flows actually look like.
Anybody?
I think Experian recently bought a company called Clarity Services or Clarity Solutions that looked at alternative sources of data. And if I'm right, I need to cross-check. I think they are looking at, because a lot of these consumers who are trying to get back on their feet after filing for bankruptcy, they have challenges, but they have tried to come up with different ways of presenting that data to lenders. So we tried to use traditional data sources as well as create our own. At that time, we did have a conversation around it, but I don't think so extensive work has been done in that space. The value in doing that, maybe it's there, but it's not tremendous at the moment.
I guess I would have a different answer. So I think I was in more traditional credit before I joined a financial technology company. I think certainly when I was in the card space, the problem to me was every financial person, whether it's a person or a company, you have an income statement and you have a balance sheet, and that's a really excellent summary of your existing financial standing. And the problem with credit bureaus is it's your balance sheet, and it's really only the liability side of your balance sheet. And so if you're trying to make decisions about how well someone will perform and pay, you're missing the income statement, and you're missing the asset side of the balance sheet. So, sometimes people say, alternative data. Like the most alternative and interesting data that we use is we extensively verify income. And we look at people's assets so that we can create a total picture of their financial health. And, lo and behold, that actually enables you to give people much better prices than if you're only looking at the liability side of their balance sheet. So, it sounds very simple when you describe it in those terms, but a lot of the most exciting alternative data that we use from my perspective is bank transaction information that shows you how much somebody makes. And it sounds so silly that you would say, how much somebody makes is this like alternative form of information for making a loan, but that really is the case.
So it's the availability of better information that allows you to make a more appropriate loan. Whereas previously, if it was lack of information, you're not necessarily offering or inclined to offer a better product. You're looking at that as more risk.
Yeah, that's right, because that information was expensive, right? So the problem is if you're making $200 per person on a credit card and it takes you $150 of someone's time to establish and verify a person's income, then you don't actually have a product that makes money. So you focus on just the thing that's cheap and easy to get, which is for a long time in the US has been information from credit bureaus.
Yeah.
But if you can all of a sudden access that information at a lower cost by using technology, then all of a sudden, at a similar cost point, you can paint a much more robust picture of this person's financial health, and that leads you to make better, smarter decisions.
There's a challenge with that, and I know a lot of folks at Prosper Daily, and they did an amazing job. But the challenge that we as startups face is the lack of amount of data. Like you rely on aggregators, and they can provide you at the max 24 months of data, and most of the time only 1 year's data. Let's take a look at it. Let's take the example of a 1099 worker, a freelancer. If you look at the market, you'll see from September to March, that's like a dead season. Like if you don't close a project as a freelancer, let's look at developers, you don't close a project, then you don't have any projects from September to March. And if you have only 12 months of data, now I don't know, every time this guy from March to September makes money, but I can't see beyond 2 years, or in most cases can't see beyond 12 months. So it becomes very difficult for me to make a lending decision. Although I can see that his expenses are good and he's watchful of how he expends, but we see this big gap and we can't see if there is a recurring theme there. And that becomes a challenge. And as time progresses, if we can solve this as an ecosystem, going back to solving it as an ecosystem versus in silos, then we could do a lot of good for the consumer.
Yeah. So to sort of add to that, I would say sort of looking at it from a macro level, I think what, especially over the past few years in sort of FinTech, I think what technology has really enabled when you look at it at a high level is better communication mechanism. So whether that's figuring out a better way to access additional data sources and being able to sort of communicate with those data providers, and then to your earlier point of communicating with your audience about like what your product does or how you're going to be accessing these data sources, or really enabling the consumer need in that fashion. I think that's, to again go back to an earlier point, I think that's what a lot of FinTech companies have done that traditional financial institutions were missing for a while. And they've caught up, but I think that mindset of being able to use technology to create a communication mechanism for additional data or create a way to talk to consumers about the data you're collecting about them, about the financial product you're providing, I think that's something that is sort of the core to it. And to your point about like thinking about bankruptcy data, you can think about sort of the flow that a consumer would go through, where it's, you don't have a U.S. credit, or you have a U.S. credit history that looks great, like fine, we can make a decision off of you. If you don't have a U.S. credit history, here's what we can do next. We can ask about your income, we can ask about your international credit data, we can ask about your bankruptcy history. We can find those data sources and communicate with you in a way where we're trying to sort of reach the same solution you are.
Great. Any more questions? Anybody?
I have a question. So I think if I recall correctly, FICO assumes about 30-ish% of the weight on repayment history in terms of how they calculate creditworthiness. And I want to say about 30% on credit utilization. So both of those things assume that one, the consumer has credit and is repaying some kind of obligation. And two, secondarily, from a credit utilization perspective, it also means that they have access to some line or some capital to draw down on. I'm curious to know from your perspective, like even before just assuming consumers need credit, is there something before that you've seen in the market that perhaps allows for consumers not necessarily building a credit history without necessarily opening up lines of credit and accessing credit? Does that make sense? I'm sorry if I'm not being very clear, but.
Go for it. Yeah, so I guess I'd say two things. One is I don't want to understate this. The reason that things like repayment history and credit utilization are such a big part of the FICO model is that ultimately how a consumer uses credit is the best way to predict how a consumer will use credit in the future. And so it's hard to sort of understate the value of that to some degree. But at the other end of that is also sort of thinking about traditional data sources and thinking about starter products and thinking about ways that consumers can build credit history over time. And in that respect, I would say the products are limited, but they are out there. There are sort of a lot of folks that are sort of working to serve a population that's sort of thin file or no file and come up with a credit product that they can sort of build up and sort of ladder up and sort of turn into a reportable history. So much of credit in the US relies on reported history though, that finding a way to build up into that system is still one of the big challenges.
One thing that we did look at ourselves, and even when part of research labs is experimented with, is looking at peer-to-peer platforms, think Venmo, and how people are interacting with money. Like if a person is always going out with another friend or a group of friends, someone else is paying and they pay them back very immediately, those can be rich sources, right? And if those data sources become available, building on top of it can give you an insight into a person's mindset. That's one example. Another example is a lot of people, when they are of age like 16 or 17, their parents open bank accounts for them, and they start pushing money to them, and they start spending money. You can look at their spend history, right? These are some examples where you can anticipate this person's behavior, although it is a challenge and it is risky, but innovation by going down that path would be interesting.
Unfortunately, we're going to have to finish. If Jonathan wants to make a comment,
Yeah, sure. I was just going to say, Capital One has been in that part of the segment or customer base for a long time. So credit cards have actually been one of the ways in which people with no credit or thin file history can get access to credit and can be responsible with it and build their credit profile and get access to other financial instruments over time. I think we've had to take the approach of being fairly conservative because you know nothing about these customers. You often get lower credit lines and higher interest rates. And we really want to incentivize those people to not get in debt and to pay off every month and build their credit. And to that point, it's been our incentive to provide more features to customers to help them do that. That means things that help people make automatic payments, things that remind them if they might be about to go late, features that help them predict their spending. And then you want to grow their product with them over time. So we have programs at Capital One to help people automatically increase their credit limit as they make on-time payments. That help them automatically get upgraded to better credit cards with better rewards so that they don't have to go outside of our financial institution to do that as well. But I would expect that more products come and kind of compete with us for those types of customers, because I think that is a really critical need. The alternative to this sort of financial product is often payday loans, which has much more punitive fees and higher interest, and often terms that lock people into situations that are not good for them.
I want to talk a little bit about, there's two things that you're trying to evaluate, right? One is the capability to pay, the ability to pay of a customer, and the second is the willingness of that customer to pay, and they're not quite the same thing, right? So on capability to pay, I think a lot of like new lenders are using products like Plaid to basically say, okay, what is your income? Do you actually have the income to pay for a particular credit product, right? The second around willingness to pay is looking for what are similar types of patterns that reflect a monthly payment for a credit card, right? So if you think about utility bills, if you think about cell phone bills, if you think about rent, those are things that are reflective of, does this person have the responsibility that demonstrates a willingness to pay on time, right? So those are kind of the two things that you can start to leverage that a lot of the new lenders are using to extend credit, and then that builds your credit report.
So I'd just like to thank all the panelists. I think it's been obviously a fantastic panel, and if we could all raise our hands. I know Victoria has to go, unfortunately. Thanks, Victoria. And we've got one pitch tonight, and that's Mark, who's been the very kind moderator of this panel. So if all the panelists would like to sit in the audience, we've just got a 3 minute, and then we'll do networking. Thank you, Mark.
So we give everybody tomatoes to start throwing. I feel like a talk show host that gets up after his program and has to sing at the end or something. But thank you for giving me just a few minutes to talk about Next Stage Partners. As I started in my introduction, we are a full-service team. We're based across the U.S., and we focus on sales, marketing, and business development for early-stage companies. I've been doing startup work, I think, my entire career. I was with Visa for many years, but did a lot of business development for them, new categories where they didn't have acceptance, or new products, new areas to build in their co-brand business, for example. And I've also been working with Stanford University StartX as a board advisor for their incubator. And the common thing that we saw, and when we're dealing with anybody, it's typically a CEO or founder of a company, is they're a little bit in a catch-22 situation. They've got a tremendous product, they've got a tremendous service or idea, but they don't necessarily have the relationships to get that launched into the market. So what we do for a short period of time, usually 6 to 12 months, is we will take over responsibility for sales, marketing, and business development. We will build a presentation that articulates the value proposition, and we will actually call on their customers. And that traditional build, operate, transfer, after a period of time, we will transfer all that back to the company. At that time, they'll be in a much better decision process to be able to hire their own head of sales, head of marketing, head of BD, and be in a much more positive revenue trajectory. One of the areas that we do, in addition to working directly with the FinTech startups, is that we also reach out to the financial institutions and help them with some of the payment strategy and the introduction of new products that augment the solutions that they have with their cardholders and their customers to make their business a little bit more relevant. Another great source for us is we work directly with a select number of VCs. These are people that have, they're not hiring us per se, but they certainly have invested in some key companies. They understand the capabilities of those companies as well as the needs, so they provide a great introduction for us to some of the companies they've invested in that might be interested in those services. So happy to talk to anybody about that, any needs that you have or people that you know afterwards. I appreciate your time. Thank you.